Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. In this episode of the Wealthy Behavior Podcast, we're wrapping up a great year with the pod in which we had amazing guests, excellent listener questions, and just generally a lot of fun delivering insight to listeners by highlighting 6 enduring, valuable strategies and lessons from our 2024 episodes. First up, Caleb Silver, editor-in-chief at Investopedia and an Emmy-nominated business journalist, shares some practical advice on personal finance and the building blocks of financial literacy. Are there building blocks of financial literacy, almost like a Maslow's hierarchy of needs when it comes to this topic, that there are just certain things you have to take the time to learn and be good at, regardless of your general interest level? And what are those?
If you want to start super young, and it's needs versus wants, and every good curriculum teaches this, what do you want? What do you need? But there's also understanding the way that money works, the way compounding works, right? In both directions. Like, what does compound interest mean on your credit card? What does compounding mean in your portfolio? How does money grow over time? But also, and this is a very fundamental thing that financial advisors like you are great at, and I steal this from Joe McLean, a terrific advisor, who I think we both know, which is, what does it cost to be you? And then what does it cost to be the you want to be? Rarely do we break that down. We do that when we sit with terrific financial advisors like you and mine. We have that conversation, but that's only a few of us who have that access to professional financial planning. But just that fundamental question is super important. Also, the difference between being a consumer and being an owner. And I speak to a lot of high schools, and I don't know if you've ever spoke to a room of 17 or 16-year-olds who really could care less about people like me. But when you start talking to them about the products they own, what they wear, what's on their phone, what's on their feet, who's on the hoodie, and then breaking it down to them that you don't just have to be a consumer here. We're saving up for that money. You can own a piece of that company. And what does it mean? And how to evaluate, equity ownership, and how to build your own portfolio so you're not just a spender, you're an investor, you're a part of the process.
And moving up the chains, maybe what are the things that you wish outside of those essentials that people would take the time to learn?
Yeah, good credit, bad credit, right? I mean,
okay.
People end up getting into these debt spirals because they don't understand how credit actually works, but also how to make credit work for you. Now, you and I know a lot of successful investors that have built amazing careers on that and fortunes, but if we don't learn that early, then we start going the other way too fast. So the understanding good credit, bad credit is super important for that, but also, where is your money and how is your money working for you? We work hard to make our money and pay our bills. And we always hear about these studies about people, living paycheck to paycheck. Well, what's your paycheck going towards, right? How is the extra money you're making working for you so that eventually when you stop working, your money's growing? Like, we don't really get to that enough and young enough. And I think that's a key lesson that helps people sort of build financial wealth and well-being over time.
And maybe there isn't an answer to this question, just given your platform and what the information you're trying to share. But at the top of this kind of hierarchy of financial literacy, are there topics that you think, unless you're really passionate about this, maybe you don't need to take the time to grind away and learn some of these things if you've got the other stuff under your belt?
Yeah, I mean, you can go very deep into the black belt territory of intermarket analysis and, again, options and derivatives trading, and building a really diverse portfolio with all kinds of different asset classes. You can do all of that, if you have the sophistication and the education and the wherewithal. But the basic building blocks of having a retirement portfolio, having savings and how your savings actually works, where your other assets are, that's where you need to be to understand really what it costs, again, to be you and the you want to be. If you have a family and you want to eventually buy a home or eventually, take care of your kids or older parents, how much is all of that actually going to cost you? That's the stuff we need right now, but also how money grows over time. That lesson, once you learn that, once that light bulb goes off, I don't care if you're 14 or 44 or 64, it changes everything.
When you're talking to folks at all levels about this stuff, what are they the most resistant to, and maybe what's the most eye-opening to them that you had to bring to their attention?
Well, I think a lot of people, especially people who have jobs in companies that have 401ks, I have this conversation all the time with people, and it always surprises me when I say to them, they say, I have a 401k and I'm contributing to it, I'm getting the match. Fabulous. That's what we want to hear. How are you allocated inside your portfolio? And they look at me like I'm crazy. I'm like, no, you have to make decisions inside that 401k so that it's actually aligned with your goals. And that's just a basic one that I come across all the time, but I come across that with people who are in their 20s and 30s who just look at me like I'm from another planet. And I also come across it with people who are very young who are just starting to invest. The idea of asset allocation, portfolio allocation, where is it and where do you want to be given your age and your goals? That's super important for folks. Also, I do this all the time. People want to show me their portfolios. Hey, look at my portfolio. I own these stocks. I own all these 44 stocks. And I say, great. What is your average share price? How much of a position have you been building over time? And they go, no, I just bought these and I think they're good. And I say, hey, buying one or two shares of something is all right, but the way to really build wealth in a portfolio over time is to build positions and dollar cost average your way in, right? So that you have accumulated a sizable position so that if it does make the move you want to make, you're actually earning real money on that, or money that you can, convert it if you eventually sell it. So that whole idea of I own a lot, but I don't understand how it works comes up all the time. And these are just basics. Now there's the very complicated stuff, of insurance and, tax advantageous investing and being an efficient investor. That's for being a little bit more complicated, but just those basics, Sammy, I hear those all the time.
They're investing, but they're not really investing, is what you're saying. Yeah. Okay. This next clip features special guest Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeff is excited for investors in international markets and shares insight on the importance of investing internationally. Historically, U.S. and international stocks take turns outperforming, right? But we've been in a very long stretch of U.S. outperformance in an environment where really a lot of third-party capital market assumptions that we look at had predicted weaker returns for the U.S. looking back over the last decade and premium, returns overseas. Why do you think the U.S. has outperformed so much? And do you think there's a catalyst for a change there going forward?
So I do think there's a catalyst. I think we've experienced it. We're starting to see new international leadership begin to pick up. But you have noted that they do take turns. And absolutely true. What I found is that every economic cycle, we get different leadership. In the 1980s, it was all about international investing, and Japan was the place to be. And in the 90s, well, it was all about tech stocks and the dot-com bubble, and the US did really well. And then that early 2000 cycle from 2001 to 2008, international once again outperformed. The BRICS did really well, of course, emerging market stocks, and Europe did very well also, led by financial stocks during that financial bubble, right? And then, of course, we went through the 08-09 recession, started the cycle from 2009 to, well, wherever we've just been here recently, and that was really led by the US. So we have seen this reversal led by behavioral as much as fundamental reasons. Now I think we've started a new cycle of international leadership. So you may say, well, wait a second. If we look at the indexes, that doesn't appear to be the case. The S&P 500 has outpaced the rest of the world. And the reason for that, I think, is the capitalization weight of that index. So much is concentrated in just a handful of AI-related stocks that have done really well, right? We've just been in this incredible boom since ChatGPT launched about a year and a half ago, the 3.5 version. We've really seen AI stocks really take off. So what I'm seeing here is that as the global economy transitions to this new cycle, markets are experiencing new leadership. We had forecast that for the first time, European stocks would lead U.S. stocks last year. They actually did. Europe's stocks 50 index outperformed the S&P 500 index, measured in dollars or euros. And that's true again this year, along with Japan's Nikkei 225 is outperforming. In fact, the performance gap last year was wider on an equal weighted basis. This is really what I'm focused on here. Since the bear market ended in October of 2022, The average international stock has outperformed the average US stock by 10 percentage points. And we can see this in those equal weighted indexes, the EFI index and the equal weighted S&P 500 index. Now, because we tend to track markets using the capitalization weighted indexes, where the biggest stocks get the biggest weight, the leadership by those Magnificent Seven stocks has resulted in the capitalization weighted outperformance by the US. But that's rare historically. Usually equal and cap-weighted indexes tend to trend in the same direction for relative performance. And I think that broader outperformance by international stocks offers more support than the US's narrow leadership going forward. So I'm really encouraged by what I'm seeing, particularly in some of those key international markets.
In this next clip, Bob Weiss, CIO here at Heritage Financial, answers a common client question. If you have the choice, should you invest a lump sum of money all at once or wade into the market by dollar cost averaging? So we have, over the course of time, answered a question a lot in client meetings, and that is the concept of dollar cost averaging. Dollar cost averaging, basically, you have a lump sum that you want to invest, and instead of, going ahead and plunking it right into a portfolio today, you spread it out in increments, let's say monthly, over a certain time period, 6, 12, 18, 24 months, whatever you happen to do. And in this conversation, we're talking about voluntary dollar cost averaging, because a lot of us are dollar cost averaging into our 401k or doing monthly savings from our paychecks, that's when the money's available. But if you have a lump sum to deploy, do you voluntarily spread out the investment, or do you put it all in at one time? And it tends to be a question you get more, I think, at certain market extremes, right? When markets are really volatile and maybe have sold off and there's a lot of concern, people ask it more. And when markets are at or near all-time highs, people tend to ask it a little bit more. So, depending on your lens, we could be day to day. I think we're more talking about this because we're at market highs, but if volatility picks up, we could get the question for other reasons. So with that, hopefully not too long of a preamble, walk us through, as a chief investment officer, when you get that question from new clients or existing clients who have a lump sum. I know you've done some research on it. What's your perspective?
Yeah, I think it's a great question and really is an interesting topic. So to kind of set the stage, say I go into a client meeting or a new client meeting, and it's someone who just sold their business, and as of this coming Friday, I'm going to have $5 million in my checking account. What do I do? And it might come with it, I'm a little scared of putting it into the market, because what if I put it all in and then the market goes down? Should we dollar cost average, say over 6 or 12 months, which would be putting 1/6 or 1/12 of that lump sum into investments, and 12 months from now you're at the fully invested portfolio. And in the meantime, what you do with the part that's not invested is it's in cash in a money market, which today has a little bit of a yield to it. Years ago didn't. So that's dollar cost averaging in a nutshell. There was some research done, an interesting study published by Northwestern Mutual a couple of years ago, and they just did a back test. They just went through time and said, if you did I think they did a 12-month dollar cost averaging schedule, how often do you call it win, meaning end up with more money, and how often do you lose, meaning you would have been better lump sum investing. And if you're dollar cost averaging into your final, call it destination portfolio, is 100% US equities, about 75% of the time, you're better off just investing in it day one. If your call it target destination portfolio is a 60-40, 60% stocks, 40% bonds, lump sum investing wins about 80% of the time, 80.22. 20% of the time you would have done better trickling in over 12 months. So these are rough numbers, and the precision doesn't really matter, but it is more in line with intuition that more often than not, markets go up. So by sitting on the sidelines with cash, you're missing out. But they don't go up every day. They don't go up every year. They do go down from time to time, and that's when you would have been better off dollar cost averaging. But the punchline is the odds are against you when you dollar cost average, and that's to begin with. It gets a little more difficult for dollar cost averaging because, as you said, Sammy, with your intro, we tend to get these questions when people are concerned about markets, when there's uncertainty, when there's market volatility. It's, oh, there's a lot of uncertainty out there. Maybe it's around an election time, but frequently after a market crash. Oh, things are scary right now. Should I dollar cost average? When things are good, we don't get the questions as much. The topics don't come up. So the numbers I read off, call it a 75 to 80% win rate. That's a back test, assuming no emotions at all based on the scenarios. In reality, I think the outcomes are a little worse than that because people tend to ask for dollar cost averaging or ask the right questions that lead to implementing dollar cost averaging around market lows.
Interesting. So you get the question more at market lows, whereas I feel like sometimes I get them when markets are doing really well. But so let's focus on that then. We get them during times of market distress.
Yeah. So thinking about it, market uncertainty. If you have certainty around an investment, that's what a U.S. Treasury bond is. There's certainty around when the coupons are going to be paid. There's certainty around when it matures, and there's certainty around what it's going to mature for. And that's why it's called the risk-free asset. So as you get some level of uncertainty, take it beyond treasuries to a corporate bond, and that's where, maybe they'll default, maybe not. You get a little bit extra return. So I think there's a pretty clear relationship in markets between uncertainty and expected return. The greater the uncertainty, the more, call it a greater spread of outcomes, greater range of outcomes, the more questionable the future is. That's risk. And with higher risk should come higher return. On the face of it, immediately it is rational. When there's more uncertainty around outcomes, more uncertainty around markets, then dollar cost averaging, you'd say, well, that makes sense, that anything could happen. There's a lot of paths. This could get really bad or could be really good. Let's dollar cost average. But when there's more uncertainty, that's more risk, and that's a higher base case expected return. So that's more how I see it. It's typically around some event. Could be COVID when COVID hit, like if it's late March of 2020, and you have that person who just sold real estate or a business, it's a bit of a scary time to just lump sum invest, just put it all to work. Would have been a beautiful time to put it to work, say on March 20th. But that's more how I see it, where the odds are already against you. And then if you're seeing more dollar cost averaging when uncertainty is higher, when uncertainty is greater, when risk is greater, which again does make sense immediately from human nature, like, oh, there's a lot of risk here. Let's be careful. Let's invest slowly. Let's trickle in. That's really when you want to lump sum invest. So it's got two things going against you: the back test, the base case, and then I feel like human nature takes you there when you really shouldn't be going there.
Just to summarize those 2 points, the monthly returns in the market more often than not are positive, right? So if you're sitting out of the market for a series of months, your expected return is not going to be as good as, plunking it all in. And then your second point, I think, connects to some of the data you've shared with us around rebalancing, in that, big sell-offs, 20% plus sell-offs are buying opportunities. They're not, times to kind of slow play into the market. So that being said, we still do dollar cost average for clients when they ask, and we've had a good conversation about the pros and cons. Because to your point, they may be new investors. There's times of uncertainty. They need to sleep at night. The better thing is to get the money in the right place long term. And if that's what it takes to get you invested, I think that's a fine strategy. The odds are that it does work against you.
Yeah, maybe one thing to add, I'll just share a quote I saw the other day that's interesting. I'm not a huge tennis fan, but this is from Andre Agassi, a tennis player I think he was in the 90s. He said, "Now that I've won a slam, I know something very few people on earth are permitted to know. A win doesn't feel as good as a loss feels bad, and the good feeling doesn't last as long as the bad, not even close." And that's the end of the quote. And there's a very direct tie, whether it's winning and losing in tennis or winning and losing on investing. There's a lot of research that shows that losing money hurts a lot more than making money feels good. So being aware of, that our clients are humans. I'm not a quantitative robot with no emotions, so I do need to be able to connect to that. That is real, and that's kind of the dynamic. Now, do clients want us to give them the rational, logical, quantitative advice, or do they want us to be aware and tuned into their emotions and know that they wouldn't want to put their $5 million to work and it going down 10%, 20% is unacceptable? So there is that human connection that can support dollar cost averaging. But I do like to stick to the numbers and make sure that we're going into it eyes wide open.
Yeah, no, absolutely. It's a great recap. Here at Heritage Financial, we have been investing in private equity for over 15 years, as we believe the asset class can add value to investor portfolios. Our CIO, Bob Weiss, explains the difference between private equity and venture capital that investors should know, and also shares some insight as to how his team goes about selecting the right products. I wanted to ask you about private equity because, and maybe I shouldn't be doing it, but I do spend a little bit of time on Twitter, X, whatever it is, and you see a lot of private equity critics, and some of it is nonsensical, as you would imagine, given the platform, and some of it's from a people that I have a tremendous amount of respect for. And the main thrust, I guess, of the more sensible people's arguments is it's really not all it's cracked up to be. The performance is not great. It requires leverage. The returns are measured in a way that, maybe overstating what it is. People like it because it's illiquid. So, it goes down. You don't know it's going down in value like you do with the stock market, second by second. And I know that you fundamentally disagree with all of that. And you are a big advocate for where it's appropriate for private equity to be in client portfolios. So I just wanted to chat with you a little bit about that.
Yeah, I think it's a good topic, and there's a lot there. So maybe I'll just start with some of the people who you might be following who are critics. Whenever I hear someone share an opinion on a topic like that, I try and think of conflicts of interest and where they're positioned. And investing in private equity is complicated. It takes a lot of resources. So at Heritage, when we invest in a private equity fund, it's a lot of work for the investment team. It's a lot of work for the operations team. It's a lot of work for the financial planning team. And we do it because we think it's in the best interest of our clients. I know some firms just outright say, I don't want to deal with the hassle. It's not worth it. So I'm a categorical no, because it's a pain in the butt, for lack of a better term. And then they're going to bash PE when they get the chance, because it's just something that they're not willing to do for their clients. So there's that profile. And the second profile is there's a lot of people who work for asset managers that have shelf products that are stock and bond funds. So, and they may cold call someone, like me, and say, what are you doing for a search? And I'll say, we're searching for private equity, and they don't have something to offer. So you get people who just get frustrated with it because it's a competitor, basically. That's one. But then getting a little deeper into.
So on that one, that is understanding the messenger and being sophisticated enough to know. And we've given simplistic versions of this before, but when you see a bond manager on CNBC smashing the stock market, maybe they're right, but maybe they're just a bond manager who is talking their book.
Exactly.
And you're talking about a much more nuanced and sophisticated way of deciphering where this message is coming from.
Yeah, so a guy or gal who sells stock and bond funds might post some stuff out there about how terrible PE is because they don't sell it, and it's their competition. So there's that, as far as you could say the haters. But then when you look at private equity, there is big dispersion and dispersion is like the spread between the good and the bad.
Yep.
So for example, in the stock market, the dispersion is pretty narrow between good funds and bad funds. It might be a few percent on average over time between, say, a top quartile manager and a bottom quartile manager. So if, say, the US market returns 8%, over 10 years, a good manager does 10 and a bad manager does 6. It's something like that, where it's like you're in the ballpark either way. Of course, 10's better than 6, don't get me wrong. But in private equity, if the average, to use the same average, if the average is also 8, good might be 20 and bad is 0 or something like that. It's really much wider. So manager selection matters a lot. When you look at these studies, in both cases, they're frequently looking at the average. So in both cases, I just gave you both an average of 8. But that's where manager selection matters in private equity, because if you get top quartile, obviously you're very happy, but even second quartile, you're by definition doing better than the average, and that typically leads to pretty good outcomes in private equity. So with that, there is good and bad in private equity. Uh, I think we're fortunate for that, frankly, from a manager selection standpoint, because it helps us identify which managers to work with. Like the stock market is pretty efficient in trying to comb through and pick the good stocks from bad stocks, and the S&P 500 is a very difficult to next to impossible job to do. But as far as private equity manager selection, I'll run through some of the good and bads that we look at, and hopefully it's intuitive and makes sense. So, for example, one of the things at the top of our list is I think there is a lot of greed in private equity, and the best way to see it is through what's called asset bloat. So firms trying to raise huge funds, and they charge like a 2% asset management fee, and they'll just look to raise as much money as possible. And you see that through just the absolute fund size. So funds that might be $30 billion in assets, you'll see it through their fundraising efforts, where they're going through multiple channels. So they're exhausting all the institutions. They're going directly to retail. They're going through intermediaries like financial advisors. They have armies of salespeople, and they're basically, shaking down the entire investor universe to get every dollar they can possibly manage. That typically does not lead to good outcomes for investors. And with that profile I'm painting, you'll also see a lot of products. So you'll see products for different sectors, different names, just a lot of product, a lot of assets, and a lot of fees. So, it's good for the people working at the private equity firm, but it doesn't lead to good investor outcomes. On the the opposite side of that, what we like to see is more measured fundraising, where a manager has a sweet spot where they're really good, and say maybe that number is a $2 to $3 billion fund. They raise 2 to 3 billion, and that allows them to make 20 investments at the right size, and they're well staffed to manage that money. And typically those capital raises will be quicker, because there is a limit and they're going to stick to it. They're going to be disciplined. So we want to see disciplined fundraising. A second is what's called the general partner commitment, GP commitment. So that's how much money the firm and the firm employees put into their own fund. We want to see a substantial commitment, so that they're aligned and they're actually investing in the fund that they're managing. So some companies, that number is very low, some it's very high. To us, that's an indicator of good interest alignment. And along those lines, another key indicator for us is what we call performance-oriented terms. So in private equity, there's typically a hurdle rate, or what's called a preferred return, that they have to hit to collect an incentive fee. Sometimes it'll be zero. And it's a God-given right in private equity to start collecting an incentive fee as soon as you earn a 1% return. Other times it might be 7 or 8%. And obviously we prefer to see 8%. So no, you're not getting an incentive fee if you just return 7%. You have to do better than 8% after your management fee before that starts kicking in. So that tells you, did they believe in their product, and what are they expecting? And then maybe even just to, I'm getting into the picking good and bad managers, but just to take a step back, what we look for and what also helps us believe that private equity can add value is through firms that operate like controlling owners and consultants, where they look to add value through improving operations, improving business strategy, improving the organization. So for example, a common area organizationally would be building out sales and marketing. They'll see a business and they'll be like, there's a great story here, but these guys are terrible at sales and marketing. So they'll buy the company, and then they'll staff up sales and marketing. And the PE firm themselves may have people who are experts in that area to help, improve the website, hire online sales and do Google ads and all the stuff that a good marketing department might do. Strategically, maybe expand into new markets, operationally improve technology. So when a good private equity firm has these resources, they buy a company, they improve the company, that leads to growth, that leads to investor returns. When you invest in public markets, it's very rare that you're doing any of these things. You're buying Apple stock and hoping they sell iPhones, but you're not helping them sell iPhones. private equity is helping them sell iPhones in the equivalent, and they can do it because they're smaller size companies that they buy.
Well, what about activist investors? But is that's just more limited in the public company space?
Exactly. That's the very narrow universe in public where you do see it, activist investors, and it's harder, it's more complicated. Typically, with activist investors, they might be looking for like change in like corporate executives, like trying to push a CEO out.
So there's a battle. There's not an ownership and unlocking assistance right from the get-go.
It's
Yeah.
more of a battle with public market companies as opposed to, I'd say, a collaborative effort to improve the business that you see ideally in private equity. So we're obviously looking for the latter, and these are the type of things that we look for. And I think if you find a PE firm that does all this, that's prudent about raising capital, has good interest alignment as far as investing in their funds, has favorable terms with fees. We look at the investor base. Typically, we want to be side by side with institutions mainly, not retail. So an institutional fund, and also looking for typically see sector expertise. So not a fund that's like jack of all trades, goes anywhere, but might focus on health, a specific sector, like there'll be a healthcare fund or a tech fund, things like that. Those, on average, typically when you look at the PE data, if you're in the second quartile, historically those have done better than public markets by a decent amount.
And so I was just going to ask you that. You've historically seen a premium with private equity versus public markets that makes it worth the effort, and you just walking us through all the things that your team looks at.
Yeah, I mean, we wouldn't do it if we didn't think it was worth it. It is, like I said at the beginning, it is more work. But yeah, we think it is worthwhile. We've been doing it here for about 15 years for our clients, and there has been an evolution with private equity. And I mentioned this earlier a little bit, how they're coming out with more retail-oriented products, and we've been looking at them and we've been passing on them. So right now where we stand is we've only been recommending private equity for our qualified purchaser clients. Those are individuals with 5 million and more of investable assets. But there are products that are available for what's called accredited investors. Accredited investor, it's 1 million of investable assets and or 200,000 to 300,000 of income, depending on how you file, single or joint. And there's more and more products coming to accredited, and to date we've passed on them because typically they look like a lot of the firms that I mentioned with greed and trying to raise every dollar from the world that's possible. That's where they're dipping into, and they happen to bring accredited products with their what I call B and C grade ideas at a premium fee. So they're the most expensive products with not even their best work. So we just pass on that. We've been just saying no thank you for 10 plus years to those things. But it is getting better, and we're getting close to seeing more viable products in that space. So that might be coming for our clients, whether it's this year or next year or in 5 years. I have seen a steady increase from stuff that was just atrocious 10 years ago to pretty close to investable right now. So
So I'm not gonna ask you on the whole behavioral aspect of people just like private equity because it isn't mark to market and they don't know when it's doing worse compared to looking at CNBC day in and day out on their stocks, because you said there's a return premium, so it's not just a behavioral advantage. But I have seen a lot of stuff, and maybe this is too technical, and we can do a shorter version of it, where people criticize how private equity returns are performance is reported, that it can lead to some unrealistic conclusions about how well a fund or a vintage has done.
Yeah, there's two main measures of private equity performance. One is IRR, internal rate of return, and that's just think of like the percentage return as if you're investing in any other investment vehicle, the rate you would have to be returning. And a second is MOIC, M-O-I-C, multiple on invested capital. And that's where you're looking for something like 2x. So if I invest $100,000 and they send back 200,000, or it's worth 200,000, that's a 2x. So you want to see, you measure both. And the reason why both are important is either one in isolation is flawed. So if you're a private equity firm and you call all the capital in day one and you hold it for 15 years and you deliver a 2x MOIC, well, you doubled my money in 15 years. That nothing special about that. That's I'm not going to do the number exactly in the call, but what's that?
Yeah, I
like?
got you. Yep.
It's not a great return.
Yep.
Now, if you have a MOIC of 2x in 3 years, that's great. And then the same thing on the IRR, where I think private equity can be criticized is if you have a great IRR but do it over a very short period of time. It's like you have what's called reinvestment risk or reinvestment issues. So if they call capital, get a 25% return in 6 months and then send it back to you, like, okay, well, that was nice for 6 months, but if you're not managing it appropriately and you were holding it in cash before the capital call, and then it comes back to you and you don't have a plan and you're holding it in cash after the distribution, the PE firm can say, hey, we were running at 25% for the 6 months that we had that invested, but before and after you got nothing. You want that 25% to run for years and years and years.
Got it.
So you just have to know how to measure it and look at both numbers.
Understood. That's a great overview. Thank you, Bob. I appreciate that. Maybe my last question, because I shared with you something I saw on X today, where basically somebody's making the case, look, a 50% private equity portfolio, 50% venture capital portfolio underperformed the market, for the last 20 years. And then when you dig in, and to this person's credit, he shared the follow-up chart. When you dig in, private equity had knocked the cover off the ball compared to the S&P, and venture capital was terrible. So what is venture capital compared to private equity? And do you recommend people allocate to venture capital?
Yeah, so venture capital, most people are familiar with the TV show Shark Tank.
Yep.
I'd think of Shark Tank as venture capital. It's seed investing, where you're investing in not much more than a PowerPoint presentation. Sometimes there's revenue, just about never profits. So think of it as just very early on investing. There's a spectrum. It can be a PowerPoint deck, and that's just true seed. And then you could have a business with some revenue but no profits. So that's all in the venture realm. Private equity is typically more for mature businesses that are profitable, and with that comes larger. So with venture, you have higher risk, as you'd imagine, and there's even higher dispersion too within venture managers.
Okay.
So a good venture fund, you can get like 6x on your money. Bad venture funds, you can lose it all, or maybe get back 50 cents on the dollar if you're lucky. So venture just comes with more risk. We've typically avoided venture for that reason. When you look at on average, what you see with venture is more risk and the same return as private equity. So with venture, it's, tread very carefully. You have to be very good with manager selection. If you're in the top quartile, it'll be an amazing experience, but you just have to be careful there. So we've done like little slivers in some multi-manager funds where we'll have like 10-20% of a fund in venture, but we have to date not done any full dedicated venture allocations, and it's because when you look on average, the risk is clearly higher and the return on average is not higher than private equity. Not to say we won't do it, but that's kind of the lay of the landscape, at least.
A wealth of knowledge, Bob Weiss joins once again, this time explaining private credit, an overview of what it is, how it can fit into a portfolio, and its connection to private equity, which we just discussed. Pivoting away from stocks and bonds, you and I wanted to talk about another investment type. And what would you consider it, Bob, private credit? Is it an alternative investment? Is it a type of fixed income? Kind of what role does it serve in a portfolio? And then, there's been a lot more talk about private credit I've seen through the content that I consume. We've owned it, 16 years or so in through different vehicles, right?
Yeah, 15 years.
So you have a lot of experience with private credit. Our clients have a lot of experience with private credit. So I thought you'd be a tremendous guy to chat with about this. So, I asked you like 5 questions there in the form of an introductory question. But first of all, what is private credit? What sleeve does it fit in the portfolio? And then how would you educate people as to what it is?
Yeah, so private credit, really the story starts back in the financial crisis in 2008. So back then and before 2008, banks, like the big Wall Street banks and Bear Stearns, Lehman Brothers, as poster childs of this, were known for making loans in addition to being a bank for savings deposits. So, consumers would and businesses would give banks their deposits, and then banks would take the deposits and turn around and make loans. And at that time, they got pretty heavily levered, I think up to like 40-1. So they take all the deposits and maybe hold back 2.5% of the deposits, but rest of it would go out into risky loans. And what happened is those loans go bad, and then there's no equity left, and the depositors lose everything. So that's kind of 2008 in a nutshell. And what happened then is regulation came in, Dodd-Frank, Basel III, and that really put limits on how much the banks can lend and what types of risks they can take with their reserves. So when they have your deposits, can they make more risky loans, or should they maybe put those deposits in treasuries? And then the regulations have put them more into the, invest your deposits in treasuries. They still do some mortgages, but the risk has shifted basically from banks to the private sector and investment firms to make loans. So if you're a private business and you need financing, 20 years ago, you might go to a local bank. Nowadays, you're going to private credit lenders. So this whole market just shifted. It left the banks who were there making the interest and went to firms that specialize in making loans to businesses, to private businesses. And that's private credit. So they're looking to raise capital from investors with the sole focus of making loans to private businesses. And the objective there, it makes sense to me, is that it's you know what you're getting into. Like, we're looking to raise money to make loans to private businesses, as opposed to the banking system redirecting deposits to private loans to make a yield spread by taking risk. So that's kind of just the evolution of what's happened, getting a little more into it, how it's grown. So it's kind of born really after 2008. And the opportunity is there in a big way through private equity. So with private equity, what you frequently see is they will buy companies with a combination of equity and debt. So if you think there's a parallel to real estate, like even with residential real estate, most people buy a house and they have a mortgage with it. Or if you're investing in commercial real estate, same thing. You have some equity and some debt. So private equity does the same thing. If they buy a company, there will be an equity check that the private equity manager brings, but they'll also do some financing. They'll borrow money to help buy the business. And the loan that they use to borrow to help buy the business is the private credit piece. So frequently private credit, it's lending money to private equity firms to buy private businesses. And they look for reasonable, LTVs, loan to value, just like you see in real estate, so that they're backed by the equity value of the company. And some of the positives about it are the interest rates are high. They're around 10 to 12% typically. So as an investor in private credit, that's the type of yield that you're seeing in today's market. Another benefit that has been realized over the last couple of years is they're typically structured with a floating rate. So the loan isn't fixed. It's like Fed funds rate plus a spread, or prime rate plus a spread. So as we've seen rates go up over the last couple of years, private credit investors have benefited from a increasing interest payment. Whereas investors in traditional fixed income securities that have fixed payments have seen prices decline as rates have gone up. And maybe lastly, one additional benefit of private credit, when you're investing in what's called the sponsor-backed deals, where private equity is the one borrowing the money, you have the backing of private equity. It's not you're just relying on one company to pay the debt. But if the company starts going south, the private equity manager can call additional capital, can do whatever it takes really to see that the debt is good, because if they default on the debt, the equity becomes worthless. That's how capital structures work. Debt holders get paid before equity holders get paid, and the private equity manager doesn't want to write their equity down to zero. So you kind of have a bit of a backstop there. So our experience, in the last 15 years in this space it has been a pretty stable source of return, for our clients doing better than the bond market, and the volatility has been, pretty reasonable. There are critics of the space. I do think a lot of them come from traditional Wall Street who are not participating in this market and view it as a competitor. And they're either criticizing this market or trying to get into it. So it's a hot topic. It's either really, depending on who you talk to, it's either I don't like it because I'm not in it, or oh, we're working on a vehicle to get in it. That's the general structure. Maybe the last thing on how we invest in private credit for most clients, we use a product called an interval fund. So it looks like a mutual fund. It has a 5-letter ticker, ends in an X. There's a prospectus. What's different about it is you can only sell the fund one day a quarter. It's for sale at different intervals, a quarterly interval. And on that sale date, the fund legally has to make 5% of its net assets available for sale. So if the fund has $1 billion in it on a quarterly base, on that quarter, there's 50 million in cash that's available. So if 3% of investors hit the sell all button and no one else trades, then they get everything they asked for. But if 10% of investors hit the sell all button, the manager only has to offer 50% of that sell all. So they give them 50 cents on the dollar, and I can see you next quarter. Again, this is kind of the message. So the structure limits liquidity. And what that does is it allows them to invest in illiquid assets, namely private credit in this case. The liquidity profile lines up nicely with that 5% a quarter, because the average term of a private credit loan is about 5 years. And if you have a 5-year bond ladder, that works out to 5% mature in a quarter.
Yeah. So 50 cents on the dollar, not 50 cents of every invested dollar. You basically get half of what you want, and then you later get the other half. How do you decide with something like this, how it fits in a portfolio? Where do you allocate it? Do you take it from bonds? Do you take it from a combination of stocks and bonds? If yields were higher with traditional fixed income, would you be less excited about private credit? How do you think about it as an asset allocator?
Yeah, the base case is we use third-party capital market assumptions to have assumptions around the level of risk in the asset. And in a nutshell, it's between stocks and bonds from a risk standpoint. So when you fit it into a portfolio, it really by default draws a little from each, a little bit from stocks, a little bit from bonds, so that the risk looks more in the middle. But we can toggle that a little bit. So if we want the portfolio to be positioned more aggressively, we can pull a little more from bonds. And if we want to position the portfolio a little more conservatively, we can fund it a little more from stocks. So we have shifted from time to time. Where is it split down the middle? Let's call it funded half stocks, half bonds, or is it split all bonds or funded all stocks? So we have used it to toggle a little bit to kind of drive the overall level of risk in the portfolio.
So Bob, you've been a chief investment officer who's owned this asset class for 15 years.
Yes.
You followed it, you know it, you're not kind of Johnny come lately to the topic. What have you seen in terms of risk? Are there a lot of defaults in this space with these loans? What kind of risk have you seen? I don't want to get into a debate about volatility, because there's less volatility with an illiquid investment, and some people would not give the investment credit for that lack of volatility, which I can understand. I don't really want to get into what is a very nerdy and pointless, investment debate. So maybe defaults is a better way of, capital loss. What have you seen in different economic environments? Because we had COVID when things temporarily slowed down. We've had other, slowdowns. What type of risk have you seen? Because we've done it through private investing. We've done it through interval funds. You've seen a lot of strategies. What are your observations?
Yeah, it's been a good asset class. I mean, I've heard people refer to it as the gift that keeps on giving. It has delivered a good yield for our end investors, and the risk has been lower than we've expected. When we look at our modeling and the numbers we put in, we have not realized the risk that we're expecting from it. So you could say we've been too cautious in our modeling, that we assume that it could have bigger declines than we've seen. But I don't think that's wrong in the sense that risk isn't out there. Private markets in general have done pretty well. over the last 15 years. And what we do here is worry about risks. And there is the risk that private equity has a tough stretch, and that would tie into a tough period for private credit. So I think it's important to not get in over your skis on it. We have had some clients, want to put more money in it than we're recommending. And we do caution them, like, don't be greedy here. If it's working, it's working. But we allocate a small piece and let it do its thing. And at the same time, don't get overextended there. So our experience has been quite positive in the asset class. I think it's important to diversify. There are more niche players in the market who don't have diversified portfolios of loans. And when you're dealing with loans, I think it is important to know that any loan can go bad, and you want to own enough so that inevitably when some do go bad, you have enough diversification that it doesn't sink the portfolio. So we've stayed away from the more concentrated funds. That's been good. And we've also stayed away from the riskier ones. So don't chase yield. Like if you can get a low to medium risk 11% or a high risk 15%, we'll take the low to medium 11 over the high 15, because that 15 may not materialize if risk happens, which inevitably it will. So we've been a little more on the defensive side within it. And I think that has paid off and led to pretty good returns for our clients.
So Bob, these are private loans. They're not bonds, so they're not rated. So
Correct.
Do you have a sense of the credit risk that clients are facing in vehicles like this?
Exactly.
Is it like comparable to high yield, or, where do you kind of put it in the credit risk spectrum?
I probably would say it's comparable to high yield, but the way they look at it, like with the LTV being, say, around 50% on average and backed by private equity, you just haven't seen the losses that you've seen in high yield. Like through 2020, you would have done much better in private credit. Our clients did better in private credit than they would have done if they held a high yield ETF, as an example. But part of that, you could argue, is the mark to market. And what I mean for our listeners by mark to market is like publicly traded bonds or stocks. The price is the last trade. And bonds, they can do some what they call matrix pricing. I won't get too technical, but just say it's basically the last trade. And if it's March of 2020 and people are panicking and everyone's hitting the sell button on risk securities and no one's buying, the price can fall through the floor. And a fundamental analyst could say, no, that price isn't right, but they have to report it. That's the price, the last trade. So part of maybe the perceived lower risk of private markets might just be due to the fact that there's not the emotional roller coaster built into the pricing mechanism that you live through when you're invested in securities that are traded publicly. And people like Cliff Asness will argue that all day long from AQR, and he's not totally wrong on that front. The lack of getting a mark every single day does make it look like it's less risky than public assets, when the fundamental risk, say if you're measuring risk not by variance in price, but say probability of loss of capital, could be more similar.
And finally, one of the most common questions people ask before retiring is, how much money do I need to retire comfortably? While financial security is essential, true success in retirement goes beyond money. Christine Benz, author of How to Retire, 20 Lessons for a Happy, Successful, and Wealthy Retirement, shares advice for those 5 to 10 years out from retirement. So what would your advice be, somebody 5-10 years out, to avoid some of the challenges that happen if you haven't thought through some of that stuff?
Yeah, I would say for people who are 5 or 10 years from retirement, I love the idea of experimenting with the idea of kind of a phased retirement. So if you're in a good position with your employer, if you like at least some aspects of your day job, can you see which parts of that job you can pull forward potentially into the future, keep doing those things, perhaps shed some responsibilities that you don't love as much. To me, that seems like a really valuable starting exercise. And for some people, the answer might be, I don't like any of this. I want to start fresh. I have other interests that I have not had time to pursue, and that's totally fine. But just to take a step back and think about some of those things that perhaps you like from your job. I had such a crystallizing conversation. It's not in this book, but with Scott Burns, who's a retirement columnist. He's now in his 80s, but he made the point to me that was so resonant, where he said, I think he tried to retire, and he said, I was doing a lot of volunteer work, and he said, I took a step back and realized my highest, best use in the world was not stocking shelves in the food pantry. He said, I liked that work. I liked how it put me in contact with other people, but I realized that I should probably continue to do some version of my life's work into the future. So he does financial education. He's very minimalist in terms of how he talks about portfolios. So for me, that was just such an influential point that, yeah, there are some aspects of my work that I really love, and it would probably be the same thing if I were to bow out and just, be on boards or whatever. I probably would not be using some of the things that I have felt most excited by during my career.
So continued self-awareness is key, right? And is there a certain personality type or who might be more susceptible to challenges early on in retirement that needs to think this through? And are there some people who are just maybe bursting with interest that they can't wait to pursue, that don't face these challenges, or is that simplifying it too much?
Well, there are a lot of layers there for sure. One profile that I think we discuss in the book is just the person who has a lot invested in their career, the doctors, the attorneys, whatever. And there are lots of different career paths that lend themselves to this, where your work identity has been very much intertwined with who you are. And so for those individuals, it can be difficult to step away. And I think it's especially important for them to think about their post-working lives, what they might do. Is there a kernel of their work that they could pull forward and continue doing? Relationships are another important dimension of this, that many of us do have strong work relationships. The data suggests that this is a particularly big deal for men, that women oftentimes have social networks that are broader than their work networks. But for men, sometimes their social networks, their pals at work, those are their main friends networks. So it's really valuable to start putting yourself out there, put yourself in positions where you might meet people with shared interests. I loved Fritz Gilbert's example on this front, where he talks about starting this charity with his wife, and Fritz fully retired from work, but his wife found herself kind of struggling after she had been caring for a parent with Alzheimer's disease. And so they launched this charity together, where they had relocated for retirement, and they had noticed all these dogs. They live in rural Georgia, all these dogs living on chains in their yards. And so they just had this simple idea. I think his wife had seen a similar charity somewhere, where they set up a charity where they're constructing fences for these dogs so that they would have more room to roam in their yards. And it turned out that this is a fabulous way to meet people, a fabulous way to have this shared passion with his wife of helping animals, and a great way to get some physical activity outside. So it just ticked a lot of boxes for them. And I love that as an example of, a second act after a career, a purpose, an idea that isn't overly grandiose, like, solving childhood cancer or something like that. Just a completely manageable task that they work on all the time. To me, that's just a beautiful illustration of how to think broadly about what you might do in retirement.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts, and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.